Ultimately, for anybody that has patience, I believe that we are really headed for these astronomical prices and gains in true purchasing power. On August 22nd and 23rd of 2011, gold put in prices that were above $1,900. And I believe that the 9 years that has elapsed since is nothing but a launch pad that gold and silver have built for not just a launch pad to the moon, but a launch pad for some truly astronomical prices. Now, if you investigate all of this, I'm sure you will come to the same conclusion. But there's some great articles I'd like to direct you towards. So what are the factors that are going to cause gold and silver to go to these astronomical prices? Who are the buyers that are going to cause gold and silver to go to these astronomical prices? And what potential crises could be the trigger events that take us there? So I'm going to start with the gold-silver main page. And one thing that's interesting is we have ratios that are below 70 again, the gold-silver ratio. So silver's price measured in gold is less than 1/70th of an ounce. Now I'm kicking myself in the butt for not buying gold. I was waiting for a pullback that never happened, and they just took off like rockets. And but I was going to buy gold, and I priced gold and silver two different ways. I priced them in dollars, but I also priced them against each other. And it's much easier for me to buy gold actually at $2,000 when it's at below the ratio of 70 than it was to buy at $1,800 when the ratio was up at it was over 100. It was 122 at one point. When it was 122, I didn't have excess cash set aside to be able to purchase. However, the factors that are going to cause the potential crisis, I highly recommend reading this article by Alistair McLeod, Gold at 2,000 plus, So Why the Fuss? This shows that the big financial crisis that the world is going to have, we don't know what is going to be the trigger. I talked about real estate in China recently and real estate in the United States. There are so many potential pins for the currency bubble that we currently have, the debt bubble, the almost everything bubble. But this article by Alistair McLeod goes through a bunch of the triggers that are in the gold sector, in precious metals, the liquidity on the commodities exchange, the London Bullion Exchange, the LBMA, and these are huge, and it exposes the banks which are not in that good a financial condition right now. It exposes them to $38 billion of potential losses. They are short. There's not enough gold there to cover everything. And if the price continues going up, they have to cover it sometime and accept these losses. And that means bailouts is what would happen. So I highly recommend taking a look at this article. It's a long article, but Alistair is a great analyst, and he's put together a real good trail of breadcrumbs for you to follow. The factors that are driving this, who's buying it? Millennials flood into precious metals. Now, millennials are people this is the small investor that we're talking about here. And they tend to jump around, all of the small investors that get invested in whatever the fad is recently. So they will jump in and out, and the jumping in and out is usually what causes losses. There could be a pullback coming at any time. I have no idea, because gold is way overbought, so is silver, way overbought. They should do a pullback. They need to work off some of the steam by revisiting their 200-day moving averages and things like that. But ultimately, for anybody that has patience, I believe that we are really headed for these astronomical prices and gains in true purchasing power. So this is about the millennials coming in and the people using the Robinhood app and buying gold ETFs and so on. But this next article is about the people that are in this for the long term. And what they're talking about here on Bloomberg is that it's got a new, wider fan base of pension funds, insurance companies, and private wealth specialists. Now, these are organizations that are going to use every pullback to add to their positions. They're going to dollar cost average in. They're not going to put $1 billion into gold tomorrow and cause a huge price spike, but they know that the rest of the economy is on shaky ground and that gold and silver are probably destined for the types of prices that I think that they're destined for. And then there are some other threats, some other pins besides a default on the commodities exchanges because of all of the short positions that the commercial bullion banks have that Alistair MacLeod wrote about. I highly recommend his article. Read that. There's also the biggest threat to the stock market is a wave of corporate bankruptcies. Now, this is because of all the debt that the banks have taken on. This is a $10 trillion corporate debt bomb is waiting to explode the U.S. economy. And they're talking about impacting the corporate debt and the economy. This next article, central bankers are caught in a leverage trap. And this one I also highly recommend. We'll put the links below this video. But they've spent years warning of the perils of excess corporate debt. The catch-22, to stave off a debt crisis, monetary policymakers create conditions that allow companies to borrow even more, increasing the potential severity of the next crisis. And this is true. No central banker wants to encourage excess borrowing. Equally, no central banker wants, I'm going to change that to will, stand by while companies default, increasing unemployment and throttling economic growth. The chosen solution to a debt crisis is more debt. There is no escaping it. You cannot cut back unless you create tremendous amounts of economic growth to offset it. And I'm sorry that's just not in the cards, the economic growth. There is nothing else central banks can do. And so they really are trapped. And one of the things that is happening is this is creating zombie companies that I've talked about many times in the past. But the debt leverage ratio, the ratio of their earnings, their net debt to EBITDA. EBITDA is earnings before interest, taxes, depreciation, and amortization. And so this is the earnings before they pay taxes on it and pay interest. So the ratio of that, they've got 2.4 times at the end of the second quarter, the highest level on record. And the bank's analysts predict that it will peak at 3.2 times. Now, the economy would have to get screaming good for this to work out. Otherwise, like it says at the end of the article, such a slowdown in activity lowers investor demand for risky assets, thereby raising the spreads and depressing the valuations. As business losses accumulate, the delinquencies and defaults rise. Banks are less willing or able to lend. This dynamic feeds on itself, potentially amplifying the downside risk into more serious financial stress or a downturn. Now, in the previous article, at the end, it says it would be devastating for the cash flow of highly indebted firms. It's possible that dozens or even hundreds of companies would look to renegotiate, pause, or maybe even default on interest payments. Default on interest payments. This means massive bailouts, not just for the big banks, but for a huge percentage of the S&P 500 companies. And the figure isn't 10 trillion, it is now 12 trillion. And 12 trillion of corporate debt defaulting wipes out the average investor. It wipes out all of these pension funds. It would be a cascading effect through the economy that would require a default. And so, the Federal Reserve may be creating $12 trillion sometime soon. So if you got anything from this, please go to goldsilver.com, download my book, check out our charts and the news stories. I want to thank you for watching. We'll see you next time.